What a way to come back. All right, so we're back from our little vacation. We have everything's up and running. The markets look so. Actually, this isn't really good at all because the S&P is up 0.2%. The Dow is down 0.5%. Who cares what oil's doing? We want the Nasdaq. Oil is weak because the OPEC is putting out more. They're trying to force the U.S. to shut down by driving prices down now. So that's a whole different dynamic. So the Nasdaq is up 0.5 point, 0.67 in fact, but it's all because of Google and Apple. Because Google and Apple just got a favorable court hearing about Google's searches. They won't have to break up their search, and Google and Apple are partners essentially on search. It's a weird kind of partnership where Apple pays Google like $28 billion a year to be the exclusive, to be their search engine. And it's interesting. And then Apple's not really going to Google for AI. But in any case, point being, things are happening, stuff is weird, and so on and so on. How about charts? Oh no, I got the one chart thing. That's annoying. I'm not going to be able to fix that right now. Webinar. See, if I press webinar, it should bring me up to a current workspace will be reloaded. Okay. Oh, now it's going to just start again. That's okay, but what about the charts? No, it doesn't fix my charts. I'm going to have to do these all again. I'm so annoyed. All right, anyway, not important, not important. There's that. And what's going on today at PhilStockWorld? Very exciting, always exciting at PhilStockWorld. So let's see what's going on over there. So what did we promise this webinar was going to be about? Does anyone remember? Changing macros and trades, yes. Ooh. Well, the biggest changing macro is, of course, trade. What is going on here? Why are you not finding your home screen? Oh, come on. It should not be that hard. I'm gonna have to make a new page. It's broken. How about this one? Visit site. Uh-oh. Hang on, guys. So the webinar is working. Am I correct on that? And PhilStockWorld is not? Is that what's happening? Don't tell me that. Hang on, I'm grabbing my iPad. Why are the screens not resolving? Oh, this is just great. Maddie, you there? Hello. Oh, sorry guys, hang on. This is a problem.
Everything okay?
Is the webinar working?
Yeah, it was. I tapped out. Do you need me to go back in and check?
No, PhilStockWorld seems to be not working. With something. I mean, check if the webinar is working first. Yes.
Yeah, let me go go really quick.
And then while the webinar is working, then go find out why PhilStockWorld isn't. It doesn't make sense that I would have done anything. Sorry about this, people. Just coincidentally, right at this moment, PhilStockWorld decided to crash. I don't know why. I'm on hold with Maddie. I'm sorry. Oh, what a pain in the ass. What is happening? So I can't get it on my iPad or on the computer.
Hello, can you hear me?
I can hear you. Can you hear me on the webinar?
Yeah, the webinar's fine. I don't
Okay,
know.
well, let me continue the webinar then, and you can find out if Scott can fix this.
Scott's not, okay.
Somebody, Maddie, somebody's got to fix this.
I know, I'm working on it.
Okay, so do that while I'm doing this. Bye.
On it, bye.
Okay, well, we won't be looking at PhilStockWorld. We'll have to look at other stuff today. Hopefully something will get fixed at some point. Damn, that pisses me off. All right. What is it? That's Yahoo. Here's go to webinar. Here is PhilStockWorld can't be found. Well, that was a lot of what I wanted to talk to you about today, was the stuff that we set up this morning at PhilStockWorld. All right, let's go to Seeking Alpha and see what they have to say for themselves. All right, so this will remind me of some of the stuff we were going to do. So Google, like I said, Google did not get broken up, which is what they thought was going to happen. And that's been a huge relief on Wall Street. And Apple, of course, is a Dow component. So everything looks better than it really is because of this. Because look, Google's up 10% for the day. That's how big of a company? $2.7 trillion company. They were $2.5 trillion this morning. You know, we talk about this a lot, but it's always important to keep in mind that's $250 billion of market cap was added to Google today. And Apple, as a, I want to say 3.5. Oh yes, 3.5. So Apple with 3.5 billion adding 3.5% is also a huge amount. Calculator. So 3,500 billion times 0.035. It's more than Google. That's 332 billion. So between the two of them, it's $580 billion of market cap has been added. Seems like a big number. Did I hit something wrong? 3500 times 0.0035. No. 035. 122 billion. Sorry, that's not what I was there. I was thinking that didn't make any sense while I was looking at it. So Google's up 250 and they're up 120, so half as much as Google. But that together is a massive amount. It's 370. So just those two stocks are adding $370 billion to the NASDAQ, which is I want to say $30 trillion index at this point. No, probably less. What is the total market cap of the NASDAQ? Oh, I really want the 100. 53 billion. That's the whole NASDAQ, not the 100 of the NASDAQ. That's a lot though, right? Holy crap. $25 trillion. That makes more sense. Okay, so 25 trillion of the NASDAQ 100. The other couple of thousand stocks will double that number, but it's really about the 100, and then the 100 is really about the 7, and that's it. Of all U.S. markets. So the total market cap, and the problem is there's a lot of cross-pollination, so it gets confusing. Like all the biggest stocks in the NASDAQ are also part of the S&P 500. And the Dow is just, Dow's just an index. It's an it's like an ETF. It's not a specific, the S&P 500 is just picking stocks, but they're not, there's no S&P exchange. Like there's a NASDAQ and there's a New York Stock Exchange. There's no S&P exchange. It's just an index. It's just a bunch of stocks that have been selected to be part of an index. So it doesn't mean anything particularly if they go on and off an exchange. That's why it's very confusing. There's a huge amount of overlap in all these things, and that's what gives you the impression that stocks move in this lockstep, because really it's all about these big market cap stocks and whether they go up or down, because they're going to drag all the indexes up and down with them to some extent, except the Russell, because the Russell is a small cap index. So it's always good to sort of use the Russell to normalize things. And the NYSE is, of course, the broadest index. So that's the one you want to use for to getting more of a baseline. But meanwhile, everything's kind of at the all-time high. And let's see where to pop this out. Oh, and it doesn't have. Oh my God, nothing is loaded properly. Not the quick short. Switch gadget. And I would like, don't know what I would like. Watch list. Let's try that. Nope, useless. Switch gadget. Market depth. No, that's not going to do it. Calculated dash. Is it a dashboard? No, it's not a dashboard. It's something I have on my other computer that I don't have here. Minesweeper. All right, maybe we should just play Minesweeper then. Give up and play Minesweeper. Anyway, so the indexes, which we will now look at elsewhere. Oof, everything's slow though. La, 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 so still out. So really not that impressive. I mean, still, like I said, it's Apple and Google. And if it wasn't for Apple and Google, and what do we say this is? The NASDAQ 100 is 25 billion. And so Apple and Google alone went up 250 plus 125 is 375. So So 375 divided by 25, 1.5%. So Apple and Google alone are up 1.5%, and the NASDAQ 100 is up 0.76%. So what that means is the rest of the index is dragging down the gains from Apple and Google. And as I said, Apple and Google are in the S&P 500 too, so they are causing all of the gains here, and they're not in the, and I'm sorry, Apple is in the Dow, but it's not helping. It's still, the Dow still dragging it all down and erasing all the gains. So the big picture is when you look at these things, this is why basically in a nutshell, why I hate ETFs, because this is what ETFs are. It's like, you know, there are good stocks and there are bad stocks, and you can buy a bunch of crap. So why would I buy an ETF when I could just buy the good stocks? It's not that hard. Just buy the 10 stocks that you actually like in the index. Don't buy the whole ETF because it picks up all the crap with it. So as you can see though, if it wasn't for that good news today on that court thing, we would be continuing yesterday's downtrend. So none of this is exciting, and you've always got to do that. You always have to like pick apart something you see. Don't take things at face value, because you've got to look and like figure out like what the real story is. Because you'd say, gee, I think it would be better. And that starts with, you got to know these basics. And I have to look it up all the time too. I keep forgetting because there's so many numbers in my head. But it's like, I do know the NASDAQ is a, you know, not that big. It's $25 billion to the NASDAQ 100. It's $50 billion to the entire NASDAQ. The S&P is about $50 billion as well, because as I said, they're essentially the same stocks. They're not that different. It's just that they're just two different ways of taking a bunch of large stocks and measuring them. So you're not, you know, so you're not going to get that much divergence. The Dow is weird because it's price weighted, so it only matters what the price of the stock is. If a stock is $500, it counts more than the stock if it's $50. But if the stock is $50, could be a $2 trillion stock, and the $500 stock could be a $1 trillion stock. Wouldn't matter. It would still have 10 times the effect. So the Dow is a stupid index. On the whole, should not be paid attention to. But the S&P and the NASDAQ are market cap weighted, so they're more realistic. And the Russell is also market cap weighted, but it's small cap stocks. So essentially, the Russell has 2,000 small stocks. There's almost no stock in the Russell that can really over affect the index. So it's an interesting thing. It's going to just respond to completely different stimulus. But that's why it's good to have different ones anyway. But look at the VIX. We were all excited yesterday. We took the VIX from 17 to 18.5, so 10% pop in the VIX yesterday, and it all given back today pretty much. And if we look on a longer term thing like days, look how weird the VIX is, huh? Gappy. That's because it rolls over. Every time it rolls over, right, the next month's VIX starts off way higher than it actually turns out. So there's constant expectations of high volatility. That's what this is. Next month will be when something big happens. Next month will be when something big happens, but then it doesn't, and the disappointment drops the VIX down every month. But it never actually happens, though this is really significant. Well, let's look at energy. As we said, OPEC is releasing more production, trying to gain market share from the US players. And so, yeah, if we slip down to 60, a lot of US production has to shut down. We're not very profitable above under $60. We're not very profitable for our oil for the most part. So US producers start shutting down. It's just not worth them pulling the oil out of the ground at that price. And we talked about those dynamics also, that sometimes it goes lower than you think because people will sell oil even if it's not profitable just to get cash flow to pay the rent and stuff. But it's a weird thing. It's not very sustainable. Then you've got, and with OPEC having so much spare capacity, this is a sensible move for them. But it hurts them too, because they were getting $70 last month, and they were getting more than $70 a month before. And the reason they're doing it now is the timing of it is, usually these are slow months. So they were going to sell less barrels anyway, so they'd rather increase their production. So the net drop of oil versus the increased production, because don't forget, Saudi Arabia only produces, and they're the biggest next to, we're actually producing as much oil as they are. We produce 13 million barrels a day. They're producing about 13 million barrels a day, but they could produce like 15 if they wanted to. And all of OPEC produces 30 something million barrels. They could produce 2-3 million barrels more per day total. And so that means that they can increase their production 10%. That would offset a 10% reduction in price. They don't care if they sell more oil, as long as they care about the money. Just like everybody else, they care about the cash flow. So keep that in mind. It's all about a cash flow game. So what they're doing is they're trying to stop the US from getting enough cash flow to keep their operation going, so that they can increase their output by 10%. And if the prices drop 10%, which would be all the way down to like not 60, almost like below 60. But if they can get it down below 60, then the US production shuts off. Their output, which they produce for 20 something a barrel, so their output, which is much more profitable than ours, kicks up, and we see what happens. Oh, hang on. Yes, Madeline?
Hi, I think it resolved.
Oh, okay, great.
Yeah, can you give it a check?
Do we never know what it was, do we? Or do they never tell us?
No, I don't think it responded, so.
Oh, yep, there it is.
All right, well.
All right, well, thank you. That's very helpful. All right, talk to you later. Bye.
Good luck. Hopefully it stays.
Yeah. So where were we? Oh no, I forgot what screen we were on. Were we looking at this? We were not looking at that. Oh, that one. There we go. Okay, oil. So anyway, so that's the logic of it. OPEC knew they were going to slow down this month anyway. So you're looking at a game theory essentially, where you have to say to yourself, well, okay, so we're going to drop, demand will drop a certain percentage for the oil, and what's the best thing we can do? Well, the best thing we can do is actually counterintuitively produce more oil, drop the price, and that will cause an increase in demand for our oil versus US oil, which will have to shut down. So you're like forcing your competitors to shut down their production so that you can sell more oil. So it's a great tactic. I mean, God bless them. That's what cartels are for. And meanwhile, our idiotic policy is not helping at all. So that's why that's happening. So oil should go a bit lower, but it's a forced low, and it will correct itself at some point. Natural gas popped back up over $3, was a huge buying opportunity down here when we called to buy at $2.75. Gasoline, there's no demand. None of this is about demand. This is all about just supply people playing with the supply. Bonds. Okay, the bonds are bad news right now. Really came back today though. Look at that. Shit. For some reason, we had a 1% rise in bonds. I guess somebody said something in the Fed that was notable. No significant movements here. Lumber getting low. Sugar getting very low. Wow. Well, lumber's super low compared to where it was earlier in the year. That's crazy. Look weekly. Yeah, cocoa came down. Sugar came way down. Orange juice down. Coffee still going up because very sensitive to climate. Cotton is down. Good for Levi's. Gold, new all-time highs. Silver, I don't know if silver's an all-time high. I think it is, though. I know gold is. Yeah, it doesn't seem likely that that's going back to 2021. I don't think it's likely that silver was higher if gold wasn't. Copper is chugging along. $5 is really high for copper. It's going to get back there. Palladium is lagging a lot. That's interesting. Meats we don't really care about, but look how expensive steak is getting. And soybeans, wheat got cheap. Everything, actually, all the ags are getting cheap. And that's even against a pretty weak dollar, so that's interesting. And Bitcoin, well, it's down. I mean, it's back from 120, but it's still pretty damn strong. I mean, that's 20,000. So we went from, we're from 20,000 to 120,000, up 500%. So it deserves a little bit of a pullback, doesn't it? Still very, very strong. And the Trump's made like $5 billion on the release of their new thing. This is not the other coin that they released earlier in the year. This is a whole nother thing of some other coin that they've now made $5 billion on over the weekend. Even though the coin lost money, even though everybody who bought the coin in the IPO has lost money because it dropped significantly on the release, but they were smart. They protected themselves from that and basically just took the money. So, it's great. It's good to be the king. You can make lots and lots of money doing crap. Stefan says, short Avgo into earnings. I like Broadcom. It's hard for me to short them. Let's take a quick look at them. AVGO. I mean, they're trading at a crazy multiple. They're trading at 36 times forward earnings, 113 times last year's earnings. But the thing about that is when you see that, assuming you believe it, that they can hit those numbers. But if they were trading at 113 times earnings last year, and now they're trading at 36 times earnings, that means they've improved themselves by tremendously. That earnings have tremendously improved. So you can't say that's bad. You say that growth is absolutely tremendous. What are these people doing? And I do like them long term. I would not buy them at this multiple, but I do like them. And let's take a look over here. We got the beige book coming out at 2, so we're going to take a close look at that too. So 1.4 trillion. Usually Qualcomm. I always look at Qualcomm. If Broadcom is expensive, I want to look at Qualcomm and see what they're getting priced at, because they're so close to being the same kind of company. Whoa! Absolutely no reason to buy Broadcom if Qualcomm is 13. You definitely buy Qualcomm. Wow. That's interesting. Why is that? Because they popped so fast that nobody kept up with them. Look at this thing moving. It's 40, 35, I don't know why, 38, 43, 44. So they're steadying off on higher sales. Profits are following along at a good clip, but they're very profitable anyway. They're 35 and 7 is 1/5 profits, 38 and 10 is 1/4 profits, 43 and 13 is 1/4 profits. So I don't think that's particularly unrealistic. You go down here and see if they have any debt. They relatively have no debt, $1.3 billion debt. So I mean, these are some really strong, solid numbers. So I would absolutely be going with Qualcomm instead of Broadcom. Why risk it? Because if Broadcom has good earnings, everybody's going to run to Qualcomm anyway. So, and they had decent beat, nothing exciting there. How did Qualcomm do last earnings? Yeah, and Qualcomm recently had earnings. as good a beat as Broadcom, but not getting any respect. I mean, a little respect, 146 to 156, but this is bullshit. And they're going to have a triangle squeezy thingies coming up too, so they'll probably pop. So absolutely Qualcomm. That wasn't your question, but that's what the answer is. And Mr. Boty. All right. QCOM is trading significantly lower PE than Avgo, with Avgo earnings coming up. I think QCOM is a better play, but you tell me what you think. So you guys would be so bored if I was looking all this shit up, right? Look at that. I mean, look at this chart down here with QCOM way underperforming, but that's a day. Oh, forget that. Let's look at a year. There you go. Way underperforming. Broadcom's up 100%. They really diverged, huh? They were kind of neck and neck. Broadcom's always been taking a premium, but then things went completely nuts starting in April. Maybe Bodie will have a good insight on this. Your intuition is well supported by the numbers. Qualcomm trades at a much lower PE. Fundamentally, Qualcomm looks like the better value play, though Avgo has a stronger AI hype. Hype is not fact. And recent price momentum. You know me, I don't care about hype. So Qualcomm PE 16, 16.5, Ford P 13. Yep, and he's seeing the same thing. Oh, and they had a split thing. Stock price 158 to 161. Is that correct? Yep, very good. Okay. Always got to check. Can't trust these guys. Way to go. What did I just do? Oh, this one. Qualcomm net margins, return equity, all healthy. Ford PE, Ford PEG, 2.5, growth solid. Automotive AI edge devices, core. Avgo, valuation expensive on both trailing and peg. AI data center, VMware, tailwinds. Analysts still bullish on the price targets. Above current, blah blah blah. For some reason, they're just hotter. Everybody's thinking about Broadcom, but that's, like I said, they're a pair trade to me. It's like I always want to look at the other one to see how they're doing, because usually one's a better value than the other, and we just pick up the one that's a better value. So Qualcomm, better PE, better PEG. Growth drivers, it's a far less crowded trade. And Avgo is capped by valuation. Qualcomm is priced for skepticism. So on the whole, I would absolutely much rather play Qualcomm, and we should play it, excuse me, in the long-term portfolio. Why not? So let's go. Now that my site works, let's go here. La 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 la. I mean, definitely. That's for me. It's a no-brainer to put that in the long-term portfolio. All right. So, hi guys. Light was down, but all better now. We're in the webinar, and we're going to add QCOM to the LTP. Now, how do we want to add QCOM to the LTP? So here's where we go to Thinkorswim. We put in QCOM. And how do we want to play Qualcomm? June. So I want to see June. I want to see January. I want to see a lot more strikes than that. And they're at 156. So first of all, I want to sell puts. I think I'd be happy selling the 150 puts. Those are 1750 here. And they are 20 bucks over here. So is it worth for 250? 499 to 650 days. So it's 500. So it's 30% more days. I'm not getting 30% more money, am I? 30% more money would be $5 basically. So we're not getting $5 more. We're getting 17. What do we say it was? 1750? 1750 and 20. And 20. So basically 250 more. I don't think so. I think I'd rather take this money here. So we would sell the 150 puts, and let's say we're going to do that. So we're going to sell 5 of them, not to be crazy, right? So let's sell 5 150 puts for 1750. So sell 5 QCOM 2027 150 puts for 1750. And how much is that? 1750 times 5, $8,750. 8750. Now, how do we want to play it? Well, we think it's undervalued. That's key. So we think it should go much higher. Oh, and it's even low in its channel. So it's just sort of like out of favor currently, but not for any particularly good reason. So I want to play it kind of aggressively, and we don't want to oversell. So what are my decisions I'm making here? I want to play it aggressively because I think this is probably the bottom. I don't want to oversell my short calls because I think it's going up. And so therefore, I want to make sure I don't get burned on my short calls. So now we go back to Thinkorswim. And now I think about how I want to construct it. So 156. The 150s are there. I know I don't want the 150s because they're going to have too much premium. $24. How much does it cost me to roll down 10 bucks? The 150s are, let's say, $29. So these are 24 and these are 29. I'm paying $5 for $10 in position. Oh, wait a minute. Oh yeah, 155s and 145s, right? How about the 135s? The 135s take me from $29 to $35. That's $6. I'm not going to pay $6 for $10 in strike. I can buy it later if it goes down. And if it goes up, I don't need it. So that's out. Now I'm looking at the 145s, which we were talking about getting for 29, versus the 140s for 32. And again, do I want to pay $3 to roll down $5 in strike? And the answer again is no, I don't. So pretty much I'm happy with these, the 145s. And they're going to be, we believe, $29. And so we're going to buy. Let's say 15. Let's not be too crazy. Let's just establish a position. So we're going to buy 15 QCOM 2027. What was the number? What do we settle on? The 145, 155s, right? No? The 145s for 29. 145 calls for 29. Oh, just 29. Now we say 500 times 29, 43,500, $43,500. All right, and we know we're going to sell 10, and the question is what strike? Well, we think it's seriously undervalued, so at least 20% higher than it is now, so about 180. So, ooh. Oh, hang on. These are 29. How much are these? These are 30. These are like 33, 32.50. It's worth that. It's kind of worth it for the extra months, but now we'll stay in 2027 for now. What do we say we want to do? The 180s? Ugh. 156, 180. So that's for 30 bucks. So if I do 30 bucks, it's going to cost me 14, 15. That's acceptable. If I do 25 bucks, it's going to cost, that's 16 at least. So if we get 16, then it's 29 minus 16 is 13. I feel better about that. Let's do the tighter one. So we're going to do these for 16, the 175 short calls. Where is it? QCOM 2027 175. Oh, and we're in the 145, so I'm glad I did that. Calls, still $30 spread for $16, and we know that's 16,000 without even using a calculator because we're so smart. All right. So we're doing that, and we're going to sell. And now when I say I don't want to oversell, I don't mean I don't want to sell a couple more than we're covered, but I'm very comfortable selling 7 QCOM. Well, let's see what month we have to sell. Oh, they have November, so I know November is my sweet spot. That's 80 days out. So if I can sell those, 156 now, so we definitely want to sell right at the money because I'm going to get, look at it, we're going to get $10.40. So we're going to sell the November 155 calls for 1040. November. So right at the money, we're basically just selling the maximum amount of premiums. $72.80. And see, the reason is 7280. So the thing is, I'm not really going to get burnt because I sold 2 extra calls when I have 18 months to roll them, right? That's not going to bite me. And we could always buy more longs. There's no skin off our back to buy some more longs. We only spent 43,000 on the whole 15 of them. So if QCOM shoots up, all we're going to do is buy some more longs to cover and be fine, or we're just going to roll them along if it goes up a normal amount. So there's almost no way we can get burned to the upside. Downside, obviously, I'd rather sell more calls. That's the whole principle of the thing. Now, we already sold 5 calls, but I don't mind having 10 longs. So sell 5. So I have to look at this. 5 QCOM November, and we believe it's going higher. So we're going to sell the 155 puts. So we'll find out what they are now. But it doesn't matter. It's like, because I know I sold the 155 calls. So if we lose on the puts, we can't lose on the calls. And if we lose on the calls, we can't lose on the puts. So all we're doing is just collecting as much more premium. So at 8:30, let's say 8:30. Not you, go away. Ugh. Next. Die. Okay. Make things that look like other things. We say they're 8:30, right? 830, and that is 4,150. There you go. See, this is how I put these things together. Oh, we're not going to do that yet. Okay, so now we're going to say that's so $43,500 minus $16,000 minus 8,750 minus 7,280 minus 4,150. So that's net 73, whatever, 7,3, I'll say 20. Whoops. Yes, that was correct. On the, and it is a $30 spread, so it's a $45,000 plus, because it's partly uncovered spread with, do the math, minus 45, 1, 2, 3, 37,680, $37,680 of upside potential. Oh, and now we'll find out what that is. And we're going to divide that by what we have, 7320, is 514%. Wow, it's a great trade. See how much fun this is? 514%. He says I hit the wrong number. So from the cash perspective, there's 514% of upside potential. We're obligating ourselves to buy 500 if it drops below 150, and we're obligating ourselves to buy 500 if it's below 155 here also. But of course, we're going to roll them. So it's, we're not really obligating at 150, but technically that's our obligation at the moment. And certainly our brokers are going to feel that way when they're doing a margin assessment. Of upside potential, plus we have 2026. We really only have 4, 5. We're gonna have 5, plus we have 5 more chances to sell $10,000 plus in premium. And that's $50,000, which is actually more than we have for upside potential. So it's $50,000 divided by 7, 3, 20, 683%. So everybody keeping up on this? So that's why I love this. So all right, so what was the point? The point was we looked at Broadcom. Qualcomm is a much better value. They're basically in the same business, doing the same stuff. Qualcomm's an exceptional bargain at this price. We're going to set up a trade that will make, if it goes up 20% like we expect it does, the trade will make $37,000, 514% of what we're putting down in cash. But also, we have a chance to sell 72 plus 4,000 less whatever, it's in the money, which is only $1 or so. We get a chance to sell puts and calls every month. And how does this work? So it starts out at 155 because we're just saying we don't know which way it's going to go. We think it'll go up. If it goes up, we're covered because we're aggressively buying here. We have 5 more longs than we do shorts. So we don't care if it goes up. So we're being a little bit more aggressive on the up, and that'll cover us if it goes down. If it goes down, we'll roll to a lower strike. And that's the thing. When you look at this 50,000, you're not going to get that most likely, because at some point you're going to get stuck with one of them, and you'll have to roll and you'll have to roll yourself out of trouble. But that's fine too, especially when you're collecting such a massive amount of money every 2 months. I mean, that's only 80 days away. So this is money we're getting in 80 days. So that's what makes it a beautiful place, an income producing play. We don't expect Qualcomm to go flying higher. We definitely don't expect it to go lower. Therefore, we're confident in our channel and we're playing it so that we have a chance to just pick up this extra income. And even if we're only half successful along the way, it's an extra $25,000 on 7,300 that we're putting down in the first place. This is a phenomenal way to spend the next year. And boy, it is a year. It's like we're so close to 2026 already. We're only talking about 1 year trades now. So soon, in November, or by November, all the 2028s will be out and we'll be playing those much more likely. But for now, it's like I don't like messing around with June because they're thinly traded by comparison. So I would rather trade 2027s and get out. So officially, that's going to be our trade. 7,300 down in cash, $45,000 spread, 37,000 upside. And plus, we have a chance to sell $50,000 worth of premium over the course of the next year or so. That is freaking fantastic. So we're going to post that. It should really be a top trade because it doesn't get much better than that as far as your likelihood of making money. I really can't imagine how we would lose money on this trade. It'll be you can hold that against me like a year from now, but I don't see how we lose money on this trade. It's too good. The setup is phenomenal. So thank you, whoever that was. What a great idea, Stefan. Okay, well, thanks so much. That was an excellent idea. Maddie says, hey, Dad, it's me. I'm still not getting response from Nick or Marcelo. Okay, well, we got it going good. All right, great. So that was resolved, obviously. Fantastic. That's how trades come about. That's why it's good if you guys talk to me in chat instead of everybody like being quiet, waiting for someone else to say something. If you think you see something interesting, you might be right, like Stefan was. Thank you. So, you know, that's a phenomenal trade. I had not been paying attention to Qualcomm. I hadn't been paying attention to Broadcom. I mean, I did look at Broadcom because I saw they had earnings coming up, and I looked at the price and I said, nah, it's a little bit high. I forgot to look at Qualcomm, but while I was talking to you guys, it reminded me like, oh, I should check out Qualcomm. And you know why? Because if I do it for myself, I'm just looking quickly to see if it is, and I go, I don't care. But if I'm about to answer a question in chat or in a webinar, then I'm going to, you know, make sure I go the next step deeper and take a closer look at other factors. And this is how we do it. I'm very proud. Very good job, guys. Teamwork. All right. The beige book. Beige book, and that's going to be Warren's job. Hello, Warren. How are you feeling? What's the last beige book you read? Beige book. Yikes. Well, actually, I should look up which one he should have read. July 16th was the last one. That's not the Warren I asked. I'm confused. Here he is. Oh, I haven't looked at the most recent. My latest available is July 16th. Okay, cool. You read my mind. Now, here's the today one. Let's do the straight up analysis first, and then the comparisons. Ooh, what's that? It did not work. That was my previous thing. go. Control C. Oh, this is one of the most telling beige books we've had in a while, really. Here's a straight up macro. Okay, beige book. Overall economic activity flat to slight growth with tariff headwinds. Most experts report flat or no change in activity. Only 4 report modest growth, so we're stagnating. Consumer spending is weakening, with many households saying wages are not keeping up with price increases. Sectors like retail, hospitality are adapting. Promotions. Okay, so when you see promotions, and it's funny, I have this reflex, and my kids get annoyed because like wherever we go, it's like I'm always ruining their fun. But I'm like, oh, look at that. Look, they got a discount that. I'm like, that's bad for that company. Higher demand for vehicle repair versus new purchases. So people are repairing their cars, not buying new ones. That's a big sign. Manufacturers are localizing supply chains and automating to offset cost inflation. This is late cycle behavior, low growth, cautious investment, and cost cutting instead of expansion. Labor market cooling under the surface. 11 of 12 report little or no change in employment. Yeah. Hiring hesitation is spreading due to weak demand and policy uncertainty, layoffs, and headcount. And we certainly don't have more policy uncertainty now because we're going to the Supreme Court over whether Trump can even put tariffs on. And if he can't put tariffs on, considering we've had a record high market with tariffs, what's going to happen? Is it all going to unwind? It's a serious debt issue too, because he's been spending like a maniac because they've been using this $600 billion in tariff revenue, which have all been theoretical, basically, to offset all of his spending increases, especially the lack of taxation as a spending increase, or the net deficit, and the military expansion and all this other shit, and $150 billion to round up the immigrants and kick them out of the country, which increases labor costs. All this stuff is happening at the same time, and it's all a disaster if his tariffs aren't offsetting the cost of all this stuff. And our debt rating can immediately fall apart. So hiring hesitation, layoffs, and headcount attrition is rising. Return to office policies, AI automation, more people are looking for jobs, signaling weakening labor demand. Immigrant labor shortages cited in half the districts, especially in construction. That's already happening, and they haven't even started yet. They've got a $150 billion budget to get millions of people out of this country and out of the workforce. Implication: this is pre-recessionary softening, not collapse. Labor demand is no longer robust and frictions are increasing. Prices, tariffs are driving cost push inflation. 10 of 12 districts report moderate or modest price growth. This is like the opposite of what we're being told. The other two say input prices are rising faster than selling prices, margin compression. So everybody's got it. It's not 10 of 12. It's 12 of 12 districts are having inflation issues. And this is the data into the middle of August. Tariffs are universally cited as cost drivers. Firms are unable or unwilling to pass through the full cost because of the consumers don't have the money to pay it anymore. Cleveland, Minneapolis actual pressure to lower prices, even with rising costs. So the consumers are so bad in Cleveland and Minneapolis that they can't even sell what they've got at the current prices. We are in a cost push inflation regime, not demand pull. Fed rate hikes don't fix this. They just add pressure on margins and hiring. Warren's key takeaway: this is textbook late cycle behavior, weak growth, margin pressure, hesitancy to hire, localized cost optimization. The economy is not yet in a recession, but the signals are converging. Tariffs are now structurally inflationary. Firms are now budgeting tariffs as a baseline cost, not temporary disruptions, not transitory, as the Fed keeps saying. Wage growth is no longer outpacing inflation. We looked at that last week when those numbers came in, and that's terrible. The Fed has data covered to cut. The slowing job market, softening prices, flat growth, justifying easing bias, but the Fed must still manage the optics. Cutting with inflation is more than 2%. Cutting with inflation more than 2% risk credibility, especially if PPI reaccelerates. Summary table. These don't come out, unfortunately, in WordPress. He does these all the time, which are fantastic, but they don't replicate in WordPress. Economic activity, flat to modest growth, mildly very, very useful, right? Mildly contractionary. Labor market weakening under the surface, hiring slows, is dovish. Prices, moderate growth, tariff-driven inputs, sticky headline CPI, consumer demand softening due to wages, disinflationary, and the sentiment is balanced to soft. Oh, yes, please. Well, basically, I would say everything has gotten worse. Let's put it that way. July was modest or flat. Now it's little or no change. Only 4 report modest growth, weaker growth momentum. Consumer spending, not going to go over everyone. Deterioration in real, like I said, everything is worse. Every single category is worse. Labor is horrifying. Oh my God. Broad softening confirmed. Wage growth neutral. Yay! Input prices. Actually, my daughter Jackie, my younger one, was here, and she's quite a good economist actually. And she's in New York City, and all her friends are, first year out of college, New York City people. And she is telling me this. She's telling me that they are absolutely already abusing all the college graduates and paying them in New York City $20, $25 an hour for first year people out of college. 20 to 25 in New York City. You cannot live in New York City with that kind of money. They're all suffering. Everybody's having a miserable time. Modest to moderate. Okay, so wage growth neutral, but signals wage disinflation. That's what's going on. They're abusing the younger people. There is this pervasive thing that we talked about. I think today we talked about it. That there's this pervasive thing that the companies are pushing on all the workers, saying you can all be replaced by machines. Don't piss me off. That's what they're saying. They're like, vacation, drop dead, no vacation, no benefits, no extra salary. Don't even think about asking for a raise. You're lucky I'm not replacing you with an AI tomorrow. That is the work environment for the younger population. Because they're like, you don't know anything, and AI knows something at least. You guys don't know shit. Persistently sticky cost push inflation. Margin compression is worsening, so that's bad for the companies who are, then taking it out on the workers. Tariff inflation is now system-wide. It's everywhere. Bifurcations of sectors. AI is up, retail's down. AI is sucking up, and I said this, I kept telling you guys, AI is sucking up all the money. There's not an infinite amount of money. It is not a positive thing when Apple says we're going to spend $500 billion on AI, or when Google says we're going to spend $200 billion on AI. This is not a good thing because they would have spent it on other stuff. There are other people in the economy who would like to have Apple spend some money, but they're not. They're redirecting all of their spending to AI development in a race. And again, it's unproductive. This is where the dot-com bubble burst. This is where all bubbles burst. They are effectively competing. Google has Chrome, has Gemini, and Elon has Grok, and OpenAI, ChatGPT has OpenAI, or vice versa. OpenAI has ChatGPT. Anthropic, who keeps getting billions and billions of dollars, and they're getting it from the companies like Amazon, who don't have anything, are giving their money to Anthropic so they'll have something. They're getting tons of money to have Claude, or Claude AI, and then you've got whatever. There's Microsoft with their thing. So with Microsoft with their totally shitty thing. Facebook with their shitty thing. Okay, so everyone is building the same thing in different flavors, but it's all AIs, and all they're going to do, it's like investing in all of the broadcast companies, the streaming companies. Where are they now? Nowhere. They all sell freaking TV shows, and they're all competing for the market share of the consumers who have less and less money available to be able to pay for TV shows. This is a catastrophe in progress. I'm not going to say it's a catastrophe waiting to happen. It's happening. It's happening. Trillions of dollars are being wasted competing against each other when they're all going to end up putting out essentially the same product, and you're just going to have to pick which one you subscribe to. And they all have these completely unrealistic dreams of making money, when in fact it's going to be just like all these streaming services. They're going to have to consolidate and move together and whatever, because it's idiotic to spend this kind of money for content. And that's what it is really in AI. In the end, it's content. It's just another way to entertain you or occupy your mind or whatever you want to call it, but it's content. And they're all spending money for the same damn thing, for very small variations of the same thing. And by the way, even if, and we have the best AI, AGI technology on the planet. I just, they had that show in Las Vegas a couple of weeks ago. I didn't go physically, but I watched everything that was going on there. And Warren and I were basically laughing at what was available. And you know, like this is the best they got so far. It's like there's no advances. There's nothing better than what there was last year, the year before. And our stuff is right at the cutting edge of what's possible. But so what? You guys have heard me interview on. You've heard me talk to some of the other AIs. You've seen the output that Robo John Oliver makes and Bodhi makes and so on and so forth. Yeah, it's better, but is it so much better that you would pay $100 a month for the service? No, you're still going to pay. You're still going to take an acceptable service for $20 a month. So whoever provides the lowest cost, because you know, at a certain point, you know, and this is true in all services, right? Because like, let's say you're standing at the airline counter. If there was a counter next to your counter that had a better agent that they said, this is our top agent, and for $20 you can get in her line, and she's faster and more efficient and whatever, 90% of the people, 99% of the people are going to stay in the regular line, not pay extra money. People won't pay more money for a better service if the service that they're getting is enough. It only has to be pretty much enough. Unless they have a really good reason, unless you have a professional need or whatever, you're not going to pay extra. This is why there are so many cheap restaurants and not a lot of expensive restaurants. Or it depends where you live. It might not seem that way. It doesn't seem like that way around here, but there are plenty of cheap places to eat. But yeah, because Jackie was down here this weekend and she was like, holy shit, things are expensive in Florida. She's like, it's almost like New York prices. And I'm like, yeah, we got lots of rich people. And we're not, and I said there, I said, we're not going to the cheap places, we're going to the good places. They're expensive. They're just as expensive as New York because they have to buy the same food for the same prices. So anyway, point being, AI is a commodity. Knowledge is a commodity. Getting your questions answered is a commodity. Look at Google. Google has dominated search for years and years. And what do? They give it away. They are certainly better than Bing. They are certainly better than Yahoo. They are certainly better than anything else out there because 90% of us use it. On every device we have, 90% of us use Google because there is no contest in who had the best search engine. And the other ones all fell by the wayside. That's what you're getting now with AI. It's the same freaking thing. They're just basically search engines, talking engines, entertainment, whatever you want to call them. It's content that you're going to pay the least amount of money for the most reasonable kind. If Google were charging, a lot less people would use them, so they never charge. They make their money on advertising and pay-per-clicks and all that stuff, because they got the market share. But in a smaller model, if they have real competition, and there's 5 different AI companies, like, well, like the streaming services, right? None of them are free anymore. They all charge something. Oh, I'm sorry, some are free. There's Pluto's free, or Tubi is free. I don't watch them. I have them. They're on my TV, but they don't have as good a content. Therefore, I pay money for Peacock. I pay money for Paramount. So I do. I pay for that tier content, but that's what I'm willing to do. But also only because it's $10 a month, and $10 a month doesn't really register. But if they were $100 a month, I would be very carefully selecting what I feel like watching this year. And oh, and by the way, and this is something I think AI should start getting involved in. What you should do, what we should all do with streaming to tell them to drop dead, is switch every quarter. So in other words, instead of paying Amazon and Netflix and Hulu and whoever all at the same time, right? Just watch Peacock for 3 months, and you will exhaust their library, and you'll be done with them. And then you go to Hulu, because it's a flaw in their plan is that you can watch all of their content that's been produced ever anytime you want. So why are we not taking advantage of that? Why are we subscribing to 4 things a year, all year long, when we could just switch from one to the other every 3 months and save 75%? You know, and again, we're too rich. We're the investing class. We're too rich to bother. It's too much. It's too annoying. But frankly, if I had a little AI app that did it, I would be silly not to, right? Because you're talking about $120 per subscription, so 300 per subscription. So that'd be like $360 a year. So why, you know, that's how much extra you're paying just for the convenience of having 4 different things. But it doesn't make sense, because you may as well just watch whatever you want to watch on Peacock and be done with it in 3 months, and you'll be sick of it. You'll be sick of Star Trek. You'll be sick of the other things that they have, and then you switch to NBC and watch and whatever. I don't know. I get my shows mixed up, but whatever they have for shows. I don't know what's on what. I have a smart TV. Just watch it stuff. But you know what I'm talking about, right? Because you'll just exhaust what's available, and then, you know, when some new show comes out, you're like, oh, I look forward to watching that in 6 months. I'll catch up and see it all. But anyway, so that's my bid for what you should do with your TV subscriptions. If only we could do everything that way. But you can, you know, and frankly, it almost doesn't make sense to own a car anymore. I told this to my kids. We had this conversation. Jackie shares a car with a friend of hers. Maddie has no car, and there's no point. You know, Maddie's in Philadelphia, Jackie's in New York. There's public transportation. The insurance is insane. If you have a car, you got to park it. So why bother? It's not worth it, because you can just, if you either take public transportation or you take an Uber, and even if the Uber is $50 or $100, the several times that you have to take an Uber compared to owning a car, it's not even a contest. There's no need. There's a viable alternative to having a car these days. But most people redundantly use Uber, and they have a car, but for whatever reason it's not convenient, or they're going somewhere in between or whatever. But especially where I live, it's like parking cars in New York, of course, also. It's like, what is the point of driving a car and then parking it somewhere and paying $50 to park? That's insane. You know, you do that 10 times a month. That's 500 extra bucks just because you own a car. Whereas you could have taken, you know, 50 Uber rides instead. Anyway, all right, so back to Beige Book. The consumer has cracked. July hinted at consumer fragility. This is all what we expected, so I'm not really surprised. August confirms it was real wages are not keeping up. Households are pulling back hard. Consumers are being squeezed. Rising cost of insurance, utilities, expenses. The labor market is bending but not breaking. The Beige Book suggested low layoffs, now more layoffs, attrition and soft hiring, all automation and return to office policies being used as tools for quiet downsizing. In other words, people don't want to come to the office, get rid of them. Cost pressures persist, but pricing power is deteriorating. And what's really awful now is that everybody, anybody who's 30 plus and went through COVID is very acutely aware of the fact that it's ridiculous to be in an office doing your work, that there's no point at all to doing it. Maybe a couple of times a week, but to sit every single week, to have to go through traffic and go an hour there and an hour back, just to do what? To sit at a desk at their place and work instead of sitting at home and working? That's ludicrous. And it's weird because the companies didn't adapt. The companies didn't downsize their space. Why? We talked about this when it was happening. Because they have 3 to 5 year leases, 10-year leases on their space. So they never downsized. And then they've been dying to have people come back and justify their space. It's the wrong attitude. They should have been saying, okay, everybody, let's build a better remote infrastructure so that when our lease comes due, we can cut it 30, 40% and knock our space down. That makes more sense. The internet and the way things work, even though PhilStockWorld just went down and we saw, there was no office to be at, but in theory, it's like the point is, if everything goes down, then you're screwed. But generally, and not every office, not every position, but there's probably 75, 80% of all office jobs don't need to be done at the office. You're only going there for the old reasons, because that's where the computer was, because that's where the network was, because that's where your communication hub is, and so on and so forth, because that's where you would have a meeting. My children are constantly having meetings. They have meetings all day long. They're on the phone with their friends all day long. They are talking, they are sharing screens, they are taking pictures, they are showing videos to each other. They are having meetings all day and all night. So when they go to the office and everybody has to sit at a table having a meeting, they think that's a horrific waste of time, because they could have a meeting with 5 of their friends at the same time on the phone in a conference call, and they don't think twice about it. They were doing that long before Zoom was invented. They had ways to do that. It's us old folks that can't relate to it, and we don't understand how to manage it. Not me, I figured it out. But but it's the older generation that looks at that and says, that's not working. You're not being productive. You're talking to people. It's like, no, they're very productive. They live in a group. They're a hive mind. And if you can harness that energy with young workers, you will do very well, because you just have to get the right team together, and these guys will constantly solve problems and talk to each other and communicate way better than any office environment you've ever been in, because that's how they grew up. They grew up talking to each other and communicating and sharing their burdens and sharing workloads and so on and so forth. They're great at that stuff. But you got to let them do it their way. You can't suddenly say, oh, no, you must do this, and this is our policy, and blah, blah, blah. It's nonsense. So where are we? Cost pressures. Tariff is obviously still here, even though it's got to go to the Supreme Court. If the Supreme Court kicks it out, we have a whole different set of problems. But we won't have the tariffs. That would be nice, kind of, for consumers. Firms can't pass it on as easily anymore. There's a classic setup for margin compression, profit cuts, and layoffs. Warren's macro synthesis: the economic momentum is fading, not falling off a cliff, but enough to justify a dovish lean. The Fed now has a credible cover to cut in September or November, especially with labor softening, tariff inflation, fiscal debt rollover risk, vigilante pressure, meaning the Fed must frame any cuts as cautious, not panic, because the bond issue is a big deal. Would you like me to build market expectations versus rage, but where disconnects are growing? Oh, sure. That's a great idea. So yeah, this is the brilliance of Warren, because he's like, he really understands how this stuff works. Expectations versus reality. Rate cuts. September cut. The Fed sees softening, but not a crisis. Tariffs still cloud the inflation path. Disconnect high. Risk of disappointment if Powell signals wait and see. He's not taking into account the Trump pressure, though. I don't see, there's no real benefit to Powell not doing a rate cut of a quarter point because it's meaningless. The quarter point is meaningless in the grand scheme of things. And it would appease Trump slightly, although he'll still be pissed if it's only a quarter point, but it'll appease Trump slightly. Inflation dynamics. Market sees disinflation trend. The Beige Book reports tariff-induced cost push impression, and the market is underestimating the stickiness of non-demand inflation for sure. Labor market strength. The market sees labor market is tight and wage-driven. The Fed districts are reporting that is not the case. Cracks are forming. The Fed is more cover to cut than priced in. Consumer health. The retail equity markets assume a stable consumer. I don't know who is assuming that. Focus on earnings. Beige Book says real wage compression, demand pullback across sectors, and this is today's news. So you got to realize this is a big disconnect. Oh, how's the market doing from all this? La da da. Nope. Trade. Active trader. Yeah, no, don't seem phased at all right now. Tariff impact transitory. It's not transitory at all. We knew that. Credit lending, markets pricing, and credit stabilization. The Fed notes flat to slow loan demand, margin pressure. Yeah, it's not happening. And people have tapped that on their houses too. Real estate sentiment, risk on positioning in CRE and ETFs builders. Beige Book only AI data centers are strong. Everything else is weakening. And again, the money is being taken from where it would have gone to other things that are not helping the people who exist. So it's great if you're a data center builder, but who's a data center builder? Most builders are not data center builders. They don't want the money going to data center builders. Possible valuation mismatch, blah, 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 global trade. Markets are not pricing in trade escalation risk post-Trump's tariffs. The Fed districts cite trade and policy uncertainty as a major business constraint, of course, and the Fed may be more hesitant to cut too soon, blah, 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 but then again, the pressure. Strategic summary, where markets are too optimistic, consumer resilience, Fed's tolerance for inflation, speed of rate cuts, insulation from trade policy. Where the Fed observations undercut the market narrative, consumer fragility is real and widespread, labor market is softening faster than headlines suggest, pricing power is eroding, tariff-induced inflation is not just a headline, it's embedded. The market is priced for perfection. Let me know if you'd like this turned into a risk monitoring. No. My only criticism is I think you are underestimating Trump's pressure on Powell to cut rates. I think just to appease him, they'll cut at least 0.25% in September. It's not worth going to war over. You're right to say I'm underweighting the real politics of Trump's pressure, especially in context of how the lame duck said. And this is basically how me and Warren converts, right? Like he'll say something and I'll say, that's great. Did you take this into account? And he'll be like, oh, okay. And he doesn't have an ego about it. So he doesn't give a lot of pushback usually, unless he thinks I'm totally wrong. But if he does think I'm wrong, he's going to give me pushback. But generally, if I say something that makes sense, he just goes, okay. And he takes it into account because he doesn't have an ego to bruise as far as like getting better. And he's always looking to like say, okay, that's great. I think, that's a smart thing to think about. So Fed's instincts avoid open warfare with the sitting president who's likely returning to power and already gunning for board. It's not returning to power. Let's sharpen this a bit. Why 25 is plausible or rational? It's a low-cost political pressure release valve. 25 points isn't much. The Fed can easily frame it as responsive and evolving labor dynamics. It diffuses Trump's narrative the Fed is choking the economy without signaling a full pivot. Powell has little to gain by fighting publicly. Fighting Trump would only invite a war on the Fed independence. Calls for firing Fed governors, pushes new appointments, direct criticism of legacy. Powell may decide it's better to exit quietly with the institution intact, even if it means swallowing a tactical cut. Yep, that's my theory. Cutting now doesn't preclude holding later. Powell could cut in September and pause afterwards. Yes. That's why I'm saying there's no reason not to. The market already expects it. Foreign central banks will likely encourage it at Jackson Hole. He doesn't know Jackson Hole happened. What's with you, man? The ECB, BOJ. I guess he's confused because last time we were talking, it hadn't happened yet. Fed cut, Powell's stability, the real cost of refusing to cut, create head-on collision, could trigger bond repricing, would leave the Fed as an outlier. Base cut. After critique 60, so he's raising his chances of there being a cut. I still think Powell will frame it around labor shortage softening, but you're right, avoiding a political knife fight. Nope. And we're post Jackson. Better catch up on the news. It's September 3rd, 2025. Let's let him give him a minute to catch up. Yeah, if he doesn't think there's a reason to look, that's, by the way, something AI does a lot, because it will use what data it's got already before it goes and looks, unless you say, I need up to date. Bullish, volatility is rising. I just wanted to get caught up. I didn't want to answer. Okay. I don't want to try the mic. Now that you are up to date, given the pivots on the ebook today and what we expect at the Fed meeting in 2 weeks. Is it 2 weeks? It's like the 19th, right? 3 weeks? Wait, 10th and then the 17th. That must be 2 weeks. How about some stock ideas to play into it? And see what he comes up with. See, I like REITs because I think no matter what, rates are going down. I think that's absolutely going to happen. REITs benefit from that. Straight up, and then okay. First Horizon benefits from lower rates through higher loan demand and improved net interest margin. Goldman Sachs kicks the boxes, of course, historically outperforming the 12 months post-cut cycle, making financials on the average plus 16.9%. Wow. All right, so that's super valid. I don't think Goldman Sachs is that cheap, but let's see. We already have JP Morgan also. I've already picked my horse in that race. How's Goldman doing? Goldman 14.5 PE, not a bad thing if you want one. They make obscene amounts of money, we know that. And debt doesn't, you can't go by debt with a financial like that. JP M. JP Morgan, same, 14.9 basically, making the same insane amounts of money, blah, blah, blah. So there you go. Those are good choices. Oh, where do you go? Okay. FHN. What's FHN up to? Not one I've looked at lately. FHN 12.2, very nice, very nice. How are we looking? 36, 32, 33, 34, 9, 9, 7. So boring, nothing going on, but nice, steady. 12.2 is it's a keeper. That's nothing you throw out of bed. So it's a good steady bank. This is one you play for we were talking earlier in chat about a butterfly portfolio play. This is what you want to play for, a butterfly portfolio. There you go. That is phenomenally boring. That is perfect for a butterfly play. The slight rise, it's going to work out the bull call spread, and it's also going to work out that you'll be able to sell puts and calls along the way. Look at that variation, 22 to 17. Even lower than 17, but like I said, all right, so basically 22 to 17 is about the low, or really this line generally holds, which is 20. So they don't vary much, but they do have a nice wiggle in a 10% range, and that's perfect for playing butterfly plays. They don't have to be flat, but flat in a channel like this is lovely, because then you know when to buy, you know when to sell more puts, you know when to sell more calls, you know when to buy back things. You know, like when this happens, you say, well, you know, you look at them, of course, and see if anything terrible happened. But you say, oh, well, so for whatever reason, they had a miss in something in earnings and people sold them off. But the reality is, I think it's a good time to get back in and buy. So that's how we make our bonus money in the butterfly portfolio, by doing things like that. So that's very nice. I like it. Russell. Caterpillar, too expensive for me. Builder's First Source. Wow, that's an interesting one. Okay. Wow. Ooh, not that cheap. Yeah. No, no. I don't think I like that. And a lot of debt. Ugh. I don't know if I agree with that one. And Caterpillar, as far as I know, is too expensive right now. Yeah, 20 times earnings is too much for Caterpillar. They are failing their 200-day moving average support, so we'll see what happens if they do come back. So let's say that's 21. I mean, really, I want to buy Caterpillar at, let's say 16, so 20% drop. So I want to see them back around 320. That's not even likely to happen. But I would, you know, that ideally, I'm not excited about Caterpillar until they get down to 350 at least. And they might, because this is disappointing, right? So they're getting a high multiple, but they're not making as much money as they used to make. It's coming back, you know, in the top lines there. So I mean, I would trust them to do it, but it's not. There's no failure here. But they are a high debt company, obviously, because of the equipment. They're a high debt company. I just don't. I don't think it's worth 21. I love Caterpillar. I'm a huge Caterpillar fan, but not now. Mohawk. No, that's not bad. Let's see. Had a great year in 2021. here, but now they're steadying up. Good, that's nice. And $8 billion, and they're making, that's good money to make. I don't mind that. Debt's not terrible, not great, but not terrible. 3 years worth of earnings is debt. And it's worth checking out. Okay, good one. Small caps have surged 7% in August, strong signal of rotation. Okay, these sectors benefit from lower borrowing costs, tech and AI, Broadcom. And we just did this. We decided we like Qualcomm better. Big tech leaders like the big guys, I'm not sure I want to go with that. Why rate cuts expand valuation multiples, tech remains. I don't agree with that. I think it's too much. EPD, we just picked as a top trade alert, Ares Capital. So we should look at Ares Capital. Pfizer, we always love Pfizer. Verizon, we have already. Valero, that's a tricky one. If oil prices are coming down, that's their input costs though. So as long as gasoline demand doesn't fall off a cliff, and I don't think it will, because Trump is reversing all of our energy policies that are driving people to conserve fuel. And it's obviously a horrible idea, but it'll be great for Valero for the short run. So in other words, lower input costs from cheaper oil and not too much of a difference in gasoline demand should be good for them. Benefit from supply constraints and favorable refining margins. That's exactly what I just said. Energy historically relies on cuts. Okay, great. So he's right about that. Valero is a good one. And let's take a look at Valero. It's kind of expensive for them, 16.7. They're usually under 15, but that's fine. I don't mind that. Look at this money. Ooh, wait, $47 billion. So they're coming in with 2.5 and 3 billion in their plans, and they weren't even planning on oil coming down like this. This is really good. How? They obviously sold something or did something to trim themselves. There's no way they went from this to that in an old way. I mean, that would be crazy. Did they knock down a huge amount of debt? Yeah, they did. They knocked several billion dollars off their debt. But I don't know. I want to get the whole story out of that before I jump in. I've not been on my action list. Consider hedges versus EM debt. Nah, no thank you. Proposed allocation, pre-Fed, overweight financials. Proposed. Okay, position, overweight financials, small caps, and energy. I don't agree with energy. Broadcom, we decided that we're going with Qualcomm, and a dividend plays, hedge with gold, capture rotation, lock value. Post-cut confirmation, trim cyclicals, add tech giants, AI plays, REITs, I said REITs. If the Fed delays or is cautious, trim defensive and fixed income fallback. Very nice. Why these moves align with our macro view? Beige book shows weakening demand, cost pressure, and wage softness. Markets price a cut 90%, but structural inflation and debt loom. Cyclicals and small caps are most sensitive. Tech and AI long-term engines. Defensive yielders and hedges offer protection. Yeah, unless they stop doing it. While I disagree and while I think we're heading to disaster, the reality is these tech guys are all just spending trillions of dollars amongst themselves. It's a big circle of spending. And so it doesn't hurt them to spend all this money in the short run, but when they end up getting no results, it's going to hurt everybody. It's going to be a disaster for the economy. Let me know if you like to model these. Now, we went. Oh, I did ask him. He was involved in that decision, wasn't he? Or was that Bodie? No, he doesn't know. We went with QCOM over. Go. So year-to-date performance, Qualcomm's up 12%, Avgo's up 28%, valuation 1422, AI exposure. It's basically the same reasons Bodie was pointing out, and that's why I love them. Heavy via NVIDIA partnership, growth profile, rebounding from the bottom, near-term peak. Dividend yield is actually better for Qualcomm. Interesting. Why Qualcomm undervalued catch-up trade at the edge? We already decided something, so what? China sales bottoming, margin expansion ahead, slow monetization, this is important, slower monetization of AI chips versus Avgo, which benefits more directly from the NVIDIA thing. Legal overhangs, especially China and Europe. Tactical play, if we do get a Fed cut in September, small cap rotation extends beyond mega caps. Qualcomm has more upside delta than Avgo. Well, we know that. You could enhance this trade with a bull call spread. Yeah, I know how to do it. Yeah. Thanks a lot. Bottom line, Qualcomm is the underdog with leverage to broadening AI and macro. Avgo is the quality name, but for this part of the cycle, Qualcomm. Yes, it's exactly my general feelings about it. I always think Avgo, Broadcom is better than Qualcomm, but Qualcomm is often a bargain compared to Broadcom, and they're Coke and Pepsi. They're both going to be around. And oh my God, did I have a lot of Pepsi this weekend? Every bar I went to had Pepsi instead of Coke for some reason. Every time we went to get a drink, it was always a Pepsi, no Coke, Pepsi. And I like my wild turkeys and Cokes. All right, folks, so that's where we are. Any more questions? Let's see. Nope, no questions. So I think we're in good shape. So that's plenty of stuff to chew on. We'll take another look at them in chat and see if we have any compelling gems. But those are all good stocks. And if you guys want to have an idea on how to trade it in chat or something like that, just ask me because I'll forget. And let's see, what else? Were we going to talk about anything else in this webinar? If we did, we have very little time. Nope, changing macros and trade ideas. There you go. That's exactly what we just talked about. I've accomplished something. I'm very proud of myself. All right, so thanks everybody for coming and have a lovely week, and I'll see you again next week. All right, take care, folks.